Think saving money is the key to riches? Think again. We're here to explore a paradox that might just change your financial destiny. Want to be rich? Don't save money. In a world where the rich seem to have secrets the rest of us don't know, we're diving deep to uncover the truth. This series will guide you through eye-opening strategies that go beyond the piggy bank, leading you to a path of financial freedom and success. From the sneaky ways inflation erodes your savings without you noticing, to the power of investing in assets that grow your wealth while you sleep. We've got it all. You'll learn why the rich get richer. Hint, it's not just about saving money, and how you can apply these strategies to your life. We'll also tackle the big questions around risk, opportunity costs, and why diversification isn't just a fancy term but a critical part of your wealth-building toolkit. Plus, get ready for some real talk about leveraging and how it can turbocharge your investments. So buckle up and get ready to challenge everything you thought you knew about building wealth. It's time to turn your financial dreams into reality, one chapter at a time. Let's get started on this exciting journey together. Chapter 1: The Invisible Thief, Inflation Erosion. Have you ever considered that the money sitting in your bank might be getting stealthily nibbled away by an invisible thief? No, it's not a cyber hacker. It's something called inflation. Imagine saving a crisp $100 bill in your drawer, only to find out a year later it can buy you less than before. That's inflation for you, reducing your money's value over time. It's like a silent alarm, slowly but surely eating away at your savings' purchasing power. Now let's talk numbers for a second. Historical inflation rates have varied, but let's say it averages around 2% to 3% per year. Doesn't sound like much. Well, it means that if you stash away $10,000 in a savings account with a 0.5% interest rate, after a year you might be losing around 2% of your money's value after inflation. Over 10 years, that's a significant chunk. Here's a more striking example. According to a study, $1 in 1950 had the same buying power as around $10.33 in today's money. Now that's a wake-up call to reconsider where you're parking your money. But it's not all doom and gloom. This chapter isn't just about highlighting problems. It's about guiding you towards solutions. Instead of letting your hard-earned money wither away in a savings account, what if you could put it to work? The world of investing offers a myriad of opportunities to not just safeguard your wealth against inflation, but to grow it. From the stock market to real estate, bonds to mutual funds, each avenue has its own charm and, yes, risks. But with risk comes reward. Let's bust a myth while we're at it. Investing isn't just for the wealthy or those versed in Wall Street jargon. With today's technology, starting your investment journey can be as simple as downloading an app and investing with as little as $5. And here's an interesting fact to chew on. If you had invested $100 in the S&P 500 index 30 years ago, you'd be sitting on over $400 today. Compare that to the minimal interest your bank savings account would have earned, and the picture becomes crystal clear. Investing is not a guaranteed path to riches, and it does require patience, discipline, and a willingness to learn. But consider this quote from Warren Buffett: "The stock market is designed to transfer money from the active to the patient." Chapter 2: The Road Not Taken, Opportunity Costs. In this chapter, we're exploring a path often overlooked by many on their journey to financial freedom: understanding opportunity costs. It's all about the choices you make with your money, and sometimes what you're not doing with it can make all the difference. So what exactly is an opportunity cost? Picture this. Every dollar in your pocket has the potential to grow if invested wisely. When you choose to keep it in a savings account, you're not just missing out on potential interest. You're missing out on the opportunity for that dollar to expand through investments. It's like choosing to walk when you have a perfectly good bike that could get you there faster. Let's get real for a moment. The average interest rate on a savings account is often laughably low, barely making a dent against inflation. Investing, however, can turn the tables. The stock market, for example, has offered an average return of about 7% per year after inflation over the last several decades. That's a game changer for your wealth-building strategy. Now, I know what some of you might be thinking, but investing is risky. And you're right, there's always a level of risk. But here's a fun fact: not investing is also a risk. By playing it too safe, you're risking the chance of your money not growing enough to meet your future needs or dreams. Consider the story of two friends, Alex and Jamie. Alex decides to invest $200 every month in a diversified portfolio, while Jamie opts to save the same amount in a high-yield savings account. Fast forward 30 years, and Alex's investment has grown significantly more than Jamie's savings, thanks to the power of compound interest and market growth. This simple decision made a profound difference in their financial futures. The beauty of investing today is that it's more accessible than ever. With robo-advisors, index funds, and ETFs, you don't need to be a financial wizard to get started. It's about making your money work for you, rather than the other way around. And here's a quote to ponder from Robert Kiyosaki, author of Rich Dad, Poor Dad. It's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you keep it for. This speaks volumes about the importance of making smart choices with your money. Chapter 3. Building Blocks of Wealth, Accumulating Assets. It's time to turn our focus towards the cornerstone of true financial growth, accumulating assets. This chapter is all about shifting gears from simply saving to strategically building a portfolio of assets that appreciate over time. First things first, let's define what we mean by assets. In the simplest terms, an asset is something that puts money in your pocket, as opposed to a liability, which takes money out. Think of assets like seeds you plant today that grow into fruit-bearing trees over time, providing you with a continuous harvest. One of the most accessible and powerful assets you can start with is the stock market. Investing in stocks gives you a piece of ownership in companies. Over time, these companies grow, and so does the value of your investment. And here's a compelling statistic to get you thinking. Over the long term, the stock market has averaged returns of around 7–10% per year, significantly outpacing traditional savings accounts. Real estate is another prime example of an asset class that can enhance your wealth. Not only does the value of real estate tend to increase over time, but it also offers the potential for rental income. It's like having a double-edged sword. You benefit from both appreciation and ongoing income. In fact, real estate has been a cornerstone in the portfolios of many of the world's wealthiest individuals. But it doesn't stop there. Bonds, mutual funds, and even starting your own business can be considered assets. Each of these options has its unique characteristics and risks, but they share a common goal: growing your wealth more effectively than a savings account ever could. Here's an interesting tidbit. Did you know that, according to Forbes, the majority of billionaires made their fortunes by owning assets in industries where they had knowledge or experience? This underscores the importance of investing in areas you understand or have an interest in. Knowledge is not just power, it's profit. Now let's address the elephant in the room: risk. Yes, accumulating assets involves risk, but here's where strategy comes into play. Diversification is the key. By spreading your investments across different asset classes, you can mitigate risk and increase your chances of success. It's the financial equivalent of not putting all your eggs in one basket. Consider this quote from Tony Robbins: "Successful people ask better questions, and as a result, they get better answers." When it comes to building your asset portfolio, asking the right questions about where to invest, how much to invest, and when to invest can lead you down a path of financial enlightenment and growth. Chapter 4. The Power of Leverage, Amplifying Your Investments. Now we're tackling a concept that, when used wisely, can significantly amplify your wealth-building efforts. Leveraging. This chapter is all about understanding how to use borrowed money or other financial instruments to increase the potential return of an investment. Leverage is a double-edged sword. It can magnify your gains but also your losses. However, when approached with caution and strategy, the benefits can be substantial. Let's break down how leverage works and how you can use it to your advantage. At its core, leveraging involves using borrowed funds to invest in an asset. The idea is that the returns on the investment will exceed the cost of borrowing, leaving you with a profit. Real estate investors often use this strategy by taking out mortgages to purchase properties, expecting the rental income and property appreciation to outstrip their loan repayments and interest. But here's where it gets exciting. Leverage isn't just for real estate. Stock investors can use margin accounts to borrow money for buying more shares than they could with their cash alone. Even businesses leverage by borrowing money to invest in growth opportunities, aiming to generate returns greater than the cost of the debt. Now let's sprinkle in some caution. Leveraging increases your exposure to risk. A downturn in your investment's value can mean losses greater than your initial stake. This is why leveraging requires a solid understanding of the investment, the market conditions, and most importantly, your risk tolerance. Here's a fascinating statistic to ponder. According to a study, leveraged real estate investments have historically offered returns that significantly outperform those of unleveraged investments, especially in markets with strong growth potential. This illustrates the power of leverage to boost your investment performance. But leveraging is not a one-size-fits-all strategy. It requires careful consideration of your financial situation, investment goals, and the economic environment. Warren Buffett famously said, Risk comes from not knowing what you're doing. This is particularly true when it comes to leveraging. Educating yourself and possibly consulting with a financial advisor can help mitigate these risks. One of the keys to successfully using leverage is to have a clear exit strategy. This means knowing when to hold, when to fold, and when to double down. It also involves keeping a keen eye on the cost of borrowing versus the potential returns and being prepared to adjust your strategy as market conditions change. Chapter 5. Mastering the Game, Diversification and Risk Management. After exploring the importance of investing over saving, the significance of opportunity costs, the power of accumulating assets, and leveraging to maximize returns, it's time to bring it all together with a crucial strategy for any investor: diversification and risk management. Diversification isn't just a fancy investment term. It's the backbone of a resilient investment strategy. It's about spreading your investments across various asset classes, stocks, bonds, real estate, etc., to reduce the impact of poor performance in any single investment. Think of it as creating a financial safety net that catches you if one of your investments falls. Why is this important? Because the market is unpredictable. Even the most seasoned investors can't always predict which way the wind will blow. By diversifying, you're not putting all your hopes in one basket. Instead, you're creating a portfolio that can withstand storms and sunny days alike. Here's an analogy to consider. Imagine you're at a buffet. If you only fill your plate with one dish and end up not liking it, you're out of luck. But if you sample a little bit of everything, you're more likely to enjoy your meal. Diversification in investing works much the same way. But diversification isn't just about having different kinds of investments. It's also about understanding and managing the risks associated with each. This is where risk management comes into play. It involves assessing the potential downside of your investments and taking steps to mitigate those risks, whether through careful selection, hedging strategies, or simply knowing when to cut your losses. Here's a compelling statistic. A study by Vanguard found that over a 20-year period, a diversified portfolio not only had lower volatility, but also outperformed a portfolio heavily weighted in either stocks or bonds alone. This demonstrates the power of diversification, not just in protecting your wealth, but in growing it over time. Risk management also means being aware of your own risk tolerance. Not everyone is comfortable with high-risk investments, and that's okay. The key is to build a portfolio that reflects your comfort level, financial goals, and time horizon. Remember, investing is a personal journey, and what works for someone else may not be the right fit for you. As we wrap up this series, consider this quote from Benjamin Graham, the father of value investing. The essence of investment management is the management of risks, not the management of returns. Wealth building is not just about chasing high returns. It's about smartly managing the risks to ensure that your financial future is secure. Diversification and risk management are your tools to master the game of investing. They're what will help you navigate the ups and downs of the market with confidence and come out ahead in the long run. Thank you for joining us on this journey to financial freedom. Remember, the path to wealth is filled with learning, patience, and strategic thinking. Keep these chapters in mind as you build and manage your portfolio. And here's to your success in mastering the game of wealth building.